Most Canadians have spent years building their RRSP, decades of contributions, decades of tax-deferred compounding, and by retirement, there might be $400,000, $600,000, or more sitting in that account. Here is what most of those Canadians do not know. If you die with a large RRSP and no surviving spouse, and if the beneficiary designations are not set up correctly, the entire balance of that RRSP is included as income on your final tax return in the year of death. Not spread over years, not taxed at a lower rate. Included as income in a single year, which means it gets stacked on top of any other income in that year and taxed at whatever marginal rate applies to the total. In Ontario, that can mean 43% or more going to CRA before your family sees a single dollar. On a $500,000 RRSP with no spousal rollover and no qualified dependent, potentially $200,000 or more going to the government in a single tax assessment. From an account you spent 30 years building. This is not a niche edge case. It is the documented reality of what happens when Canadians do not plan for it. And the difference between this outcome and a dramatically better one is not a complicated legal structure or an expensive advisor. It is a few specific decisions, some of which take less than 5 minutes to make, that most Canadians have never made because nobody explained why they mattered. This video explains exactly what happens to your TFSA, your RRSP, your non-registered investments, and your home when you die in Canada, and the specific actions that protect each of them. Let's start with the part most Canadians get right. Canada does not have an inheritance tax and does not have an estate tax. If you receive money from someone who has died, you do not generally pay tax on the receipt of that inheritance. The money comes to you and it is yours. But here is what Canada does have and where the tax happens. At the moment of death, the Income Tax Act treats certain events as if they occurred immediately before death. Specifically, two things: deemed disposition of capital property. Non-registered investments, stocks, ETFs, mutual funds held outside a TFSA or RRSP are treated as if they were sold at fair market value immediately before death. Any accrued capital gains are triggered and included as income on the final tax return. If you held a non-registered stock portfolio worth $300,000 with an adjusted cost base of $150,000, the $150,000 of accrued capital gain is triggered on the final return at the capital gains inclusion rate, 50% in 2026 for most amounts. So $75,000 of additional taxable income in the year of death. Deemed deregistration of registered accounts, RRSP and RRIF balances are treated as if fully withdrawn immediately before death and included as income on the final tax return. The entire balance in 1 year. This is the mechanism described in the hook. What is not taxed in the same way? The TFSA, tax-free on death regardless of balance, because contributions were after tax. No income inclusion on the final return. The Principal Residence Exemption applies to shield the capital gain on a qualifying home from tax in most situations. Life insurance proceeds generally received tax-free by named beneficiaries. Probate, a second consideration. Probate is the legal process by which a will is validated and an estate is administered through the provincial court system. It involves probate fees, in Ontario, approximately 0.5% on the first $50,000 and 1.5% on amounts above $50,000. A $1 million estate in Ontario would face approximately $14,250 in probate fees. Assets with named beneficiaries, registered accounts, life insurance, typically bypass probate entirely and flow directly to the beneficiary without court involvement. Here is the vault. The TFSA is the simplest account to handle at death because it creates no income tax. But the designation you have on it determines whether the transfer is clean and immediate or complicated and potentially partially taxable. And the difference between the two designations is something most Canadians have never been told. Option 1. Successor holder. Spouse or common law partner only. If your spouse is named as successor holder, your entire TFSA, including all growth, transfers directly to them with zero tax, no probate, and no impact on their own contribution room. The TFSA simply continues as the survivor's TFSA. The tax-exempt status is maintained. The account does not close and reopen. It continues, with the surviving spouse now as the new holder. This is the best possible outcome for a married or common law couple. Option 2. Beneficiary, spouse, children, or anyone else. If you name a beneficiary, for example, an adult child, the TFSA value transfers to them. The transfer itself is not taxed. However, the TFSA ceases to be a TFSA at the moment of death when the successor holder designation is not in place. Any growth that accumulates between the date of death and the date the assets are distributed to the beneficiary may be taxable as ordinary income. If your estate takes 6 months to settle, and the TFSA grew by $3,000 in that period, that $3,000 may be taxable to the beneficiary, even though the original balance was not. The Income Tax Act only allows the tax-exempt status of the TFSA to be passed on to a spouse or common law partner who is a successor holder, which differs from a beneficiary. Option 3. No designation at all. If there is no successor holder or beneficiary designated in the TFSA contract or will, the property held in the TFSA is directed to the deceased holder's estate and is distributed according to the terms of the will. This means the TFSA goes through probate, paying probate fees, waiting for estate settlement, and potentially facing the same post-death growth taxation as the beneficiary scenario. The specific action to take: log into your brokerage or bank account, find the TFSA beneficiary designation section, and confirm whether your spouse or partner is listed as a successor holder, not just a beneficiary. If they are listed as a beneficiary rather than a successor holder, contact your institution to change the designation. This is a 5-minute call or online form. It protects the entire account. The Quebec exception: Quebec cannot name successor holder directly on TFSA. Must be done through will or marriage contract. Quebec residents should speak to a notary about how to achieve the equivalent protection through their will. This is the segment most Canadians need most urgently, because the RRSP is where the largest, most avoidable tax bill at death typically originates. What happens to an RRSP at death? The basic rule: when an RRSP holder dies, CRA treats the entire RRSP as if it was deregistered, collapsed, on the date of death. The full fair market value of the RRSP is included as income on the final tax return. If the RRSP is worth $400,000 and the deceased had $50,000 of other income in the year of death, the total income on the final return is $450,000. At Ontario rates in 2026, the marginal rate on income above approximately $246,752 is 53.53%. A very large proportion of the RRSP can go to CRA in a single assessment. The spousal rollover: the mechanism that defers this tax. If a surviving spouse or common law partner is the named beneficiary of the RRSP, the RRSP value can be transferred directly to the survivor's RRSP or RRIF without triggering the terminal tax in the year of death. The tax is deferred until the surviving spouse eventually withdraws from their own RRSP or RRIF, at which point it is taxed as ordinary income in the year of withdrawal, ideally spread across multiple years in retirement at lower marginal rates. This is a significant deferral benefit and is the reason naming a spouse as RRSP beneficiary is almost always the optimal decision for married couples. What the RRSP beneficiary designation does and does not do. The beneficiary designation on the RRSP contract controls who receives the RRSP, and it overrides the will. Note, your will does not automatically override RRSP beneficiary designations. Financial institution contracts control RRSP beneficiary. If your will says your children receive everything but your RRSP names your brother as beneficiary, the RRSP goes to your brother. This happens. It causes family conflicts and expensive legal disputes. Keep beneficiary designations and the will consistent and current. The scenario without a spouse. The difficult one. Without a surviving spouse to roll the RRSP to, and without a financially dependent child or grandchild who qualifies for the rollover, the full RRSP balance lands on the terminal return. Many Canadians don't realize this until it's too late. A large RRSP with no spouse to roll it to can result in close to half of the account going to taxes. The RRSP meltdown strategy. Planning for this scenario. For single Canadians, divorced individuals, or those who outlive their spouse, a proactive RRSP drawdown strategy can reduce the terminal tax significantly. Rather than allowing a large RRSP to continue growing and creating an enormous terminal tax bill, gradually withdrawing from the RRSP in the years before death, converting some to TFSA, spending some, or donating some to charity, reduces the balance that will be included on the final return. Spreading the withdrawals over multiple years keeps the income in lower marginal rate brackets each year, rather than concentrating it in a single enormous terminal return. The RRIF consideration, an RRSP must convert to a RRIF by December 31st of the year the holder turns 71. The RRIF has mandatory minimum withdrawals that increase with age. At death, the remaining RRIF balance is treated identically to an RRSP, included as income on the final return unless the spousal rollover applies. The beneficiary designation on the RRIF controls the transfer, not the will. Non-registered investments, the deemed disposition. As covered in Segment 1, all non-registered investments are treated as sold at fair market value immediately before death. Any accrued capital gains are triggered. At the 2026 capital gains inclusion rate of 50% for individuals on gains below $250,000. Confirm current rates. The inclusion rate has been subject to proposed changes. The taxable income from a $200,000 capital gain is $100,000 added to the final return. How to reduce this? A few specific strategies. Spousal rollover applies here too. Non-registered investments can be transferred to a surviving spouse at the adjusted cost base, rather than fair market value. Deferring the capital gains until the surviving spouse eventually sells. Name the spouse as beneficiary of non-registered accounts where possible. Or structure the estate so that capital property passes to the spouse through the will. Charitable donations at death. Canadian tax rules allow charitable donations made in a will or as a direct beneficiary designation to generate a charitable donation tax credit that can offset capital gains triggered on the terminal return. For estates with significant accrued capital gains and philanthropic intentions, a strategic bequest to a qualified charity can meaningfully reduce the terminal tax. The principal residence, the exemption most Canadians qualify for, the Principal Residence Exemption, PRE, shields the capital gain on the sale of a qualifying home from capital gains tax. On death, the home is deemed to have been sold at fair market value, but if the PRE applies, there is no taxable gain. For most Canadians who own one home and have lived in it as their principal residence for all years of ownership, the PRE eliminates the capital gains tax on the home's appreciation entirely. This is one of the most significant tax shelters available to Canadians, and it applies at death through the deemed disposition exactly as it would apply on a regular sale. The exception, if the home is not the principal residence for all years. If the home was used as a rental property in some years, only the years it was designated as the principal residence are sheltered. The years it was rented produce a proportional capital gain. This is something to be aware of for Canadians who have rented out part of their home or used it as an investment property in prior years. Everything covered in this video comes down to 5 specific actions. None of them require a lawyer or a financial advisor to initiate, though for complex estates, professional advice is genuinely worth the cost. These 5 actions are the minimum viable estate plan for most Canadians. Action 1. Check and update your TFSA designation. Log into your brokerage or bank account. Find the Beneficiary Designation section for your TFSA. If you have a spouse or common law partner, confirm they are designated as successor holder, not just beneficiary. If the designation says beneficiary for your spouse, call your institution and change it. If you have no designation at all, add one, either a successor holder, spouse, or a named beneficiary, anyone else. Takes approximately 5 minutes. Action 2. Check and update your RRSP and RRIF beneficiary designations. Find the RRSP beneficiary designation at your financial institution. If you have a spouse or partner, confirm they are the named beneficiary to enable the spousal rollover at death. If your RRSP names your estate, your children, or is blank, and you have a spouse, this needs updating. Contact your institution or complete the form online. This is likely the most financially consequential 5 minutes of your estate planning. Action 3. Make or update your will. A will controls everything that does not have a named beneficiary. Your home, your non-registered investments, your personal property, your bank accounts. If you die without a will, intestate, provincial intestacy rules determine who receives what, and those rules may not match your intentions. A basic will drafted by a lawyer costs approximately $300 to $1,500 depending on complexity. Online will services are available for simpler situations. Do not skip this. Action 4. Review your beneficiary designations for consistency with your will. Beneficiary designations on registered accounts often override what your will says. So, even if your will is perfect, your RRSP and TFSA could still transfer differently than you intended if the beneficiaries aren't updated. After updating either the will or the designations, verify that both are consistent with each other. A common mistake: updating the will after a divorce, but forgetting to remove the ex-spouse from the RRSP beneficiary designation. Action 5. If you are single or widowed with a large RRSP, consider speaking to a tax professional about RRSP meltdown strategy. The terminal tax on a large RRSP without a spousal rollover is one of the most significant avoidable costs in Canadian estate planning. A tax or financial advisor can help model the optimal drawdown rate to spread the RRSP income across multiple years, reduce the terminal tax, and potentially redirect some of the withdrawn funds to a TFSA while you still have room. Let's come back to where we started. A large RRSP. No surviving spouse. No planning. Nearly half going to CRA before the family sees a dollar. Here is what that same scenario looks like with the decisions in this video made properly. The TFSA has a successor holder designation. It transfers to the spouse immediately, tax-free, bypassing probate, with no impact on their contribution room. The RRSP names the spouse as beneficiary. The full balance rolls into the survivor's RRSP with zero terminal tax triggered, the tax deferred to lower income retirement years when it will be managed thoughtfully. The will is current and consistent with the registered account designations. The non-registered investments include a spousal transfer mechanism that defers capital gains. The home qualifies for the Principal Residence Exemption. None of these outcomes required a complex legal structure. They required a few specific decisions, most of which took less than 15 minutes to implement, made at some point before the event that triggered them. The difference in outcome between the planned version and the unplanned version can easily be $100,000 to $200,000 or more, depending on the size of the estate. And the cost of not doing it is paid entirely by the family you leave behind. Do actions 1 and 2 this week. Start the will process. Review the consistency. These are the 5 things.